Good morning. It's Jeff Cleaver with the Business Healthcare Group, and I would like to thank all of you for joining us this morning for the continuation of our Delivering Value series symposiums. The symposium that we have this morning is the Consolidated Appropriations Act Compliance Broker Consultant Compensation Disclosure Rules. I was fortunate enough to hear both Darren and James when they presented on the same topic for Leapfrog approximately 2 months ago. And I can assure you that you will find the presentation from both Darren and James this morning to be very informative and to provide information that you can use to move forward to ensure that you're meeting your fiduciary responsibility for your health plan. And in addition, to ensure that you are covering your basis for all of the rules under the CAA. So I would like to thank all of you for taking time to join us this morning, and even more so, I would like to thank both Darren and James for taking time to prepare for the symposium this morning and taking the time to share with us this morning. Now, as we go through the presentation this morning, I want to ensure that every one of you are aware that the presentation is being recorded. And then in addition, as you have questions, all you simply need to do is to type them into the questions box, and then we'll address those questions. First of all, at the end of James, his part of the program this morning, and then at the end of Darren's, then we'll open it up for questions for both at the end also. So with that, I'll turn this over to both Darren and James to do a brief introduction for themselves, because I'm sure they'll do a far better job than I would ever be able to do. So with that, Darren.
Morning, and thanks for having me. You guys all have to bear with me. My voice is recovering. I had COVID earlier this week, and I'm still not feeling 100%. So if I have to pause and cough or something like that, I won't make you listen to it. But so I have basically kind of a tri-part affiliation. So the capacity that I'm speaking as today is as the executive director of a committee called the Committee for Fee-Only Benefits Advisors, basically championing transparency and direct fee compensation in the consultant-client relationship. That's the first one, the most important one for today. The second one is that I am a director at a nonprofit in DC called the Institute for the Fiduciary Standard that focuses on advocating for fiduciary issues in financial services, not employee benefits, but a very parallel industry, both governed by ERISA in important ways. And that's kind of how I cut my teeth on these issues and started learning about them several years ago. And then the last one is that I actually work for a benefits consulting firm as a business development analyst. So I sort of get a really wide view of some of these issues because I come at it from 3 different perspectives. But I think about them often, and that's why I'm with you today. So I'll hand it off to James.
Thank you, Darren. I'm James Gelfand. I am an ERISA attorney and government relations professional with about 20 years experience doing that. Have spent time working on Capitol Hill on healthcare policy issues as well as regulatory issues, and have spent many, many years working with employers as a trade association professional. And what I'd like to do now is just advance the slides to an introduction of my organization, which is called the ERISA Industry Committee, or ERIC for short. ERIC is a trade association that represents about 100 of the nation's very largest employers. They're in every industry, in every region, in every part of the economy. But what they all have in common is that they're large and they provide comprehensive employee benefits to their employees, their families, and often to retirees as well. And that's what we advocate for them employee benefits issues, from healthcare to retirement and pensions to executive compensation, paid leave on the federal, state, and local level. So we are advocates. We work closely with Capitol Hill and with the executive branch to develop legislation and regulations to help govern employee benefits plans. And then we also will engage from time to time in the court system to attempt to overturn or advance various policies using the judicial branch. So we offer expertise. Our membership does benchmarking and best practices. It's an opportunity to meet with other employers who are large and have that large employer focus. And then we don't just tell them what's going on. We try to make change to make the regulatory and legislative environment better for employers. And that, in a nutshell, is what we do. So if it's all right with my fellow presenters, I'd love now to roll into my presentation and talk a little bit about the Consolidated Appropriations Act and how it came to be, a little bit about the fiduciary obligations that all of you are going to be thinking through in the coming days, weeks, months, and years. Talk a little bit about the changes that have been made and how that affects you and the risks that are there and the things that you might want to consider doing to prepare for what some of those consequences could be. So without objection and hearing none, I'm going to go ahead and move forward. So let's start by talking about the Consolidated Appropriations Act. If you were to type Consolidated Appropriations Act text into Google, you would probably get a hit on congress.gov. But if you were to click it, I guarantee you your computer is going to freeze. And the reason it's going to freeze is because the Consolidated Appropriations Act was an omnibus piece of legislation passed in late December of 2020 that not only funded each individual federal agency, but contained a host of different policies. Many of those policies have absolutely nothing to do with employee benefits. In fact, only this much of the bill is actually focused on employee benefits, but that part of the bill is quite consequential. And I think that those of you who have followed maybe some of the debates that took place on television and in the media know that that was the bill that included the No Surprises Act, which outlawed so-called surprise medical billing. But it also contained a number of transparency provisions. And one of those provisions was a transparency requirement for brokers and consultants to group health plans. So why was that something that Congress felt needed to be included in a piece of legislation? And I think the answer to that question is that a number of media stories had come out prior to passage of CAA that showed that there could potentially be conflicts of interest in the relationships that were taking place between an insurance broker or a consultant that was advising an employer on making choices about their group health plan, wherein the consultant or broker may have been getting some kind of revenue stream from the very products that he or she was recommending to the employer. So you can imagine how this could be a conflict of interest. And some of the media stories were quite explosive, right? So there was one, I think I've linked to the National Public Radio piece here on this slide. When this one made the rounds, Capitol Hill was aghast because it told stories about huge rewards being lavished upon brokers if they could convince an employer, oh, use this insurance company and not that insurance company. Go with the HDHP and not with the HMO, etc. And these kinds of choices, they should be made based upon the best interests of the employees, not upon the best interests and the way to make the most money for the broker. And of course, the same thing was happening with some of the large consultant houses, wherein they would offer employers a menu of vendors to choose from, but the only way the vendor could get onto that menu was to essentially pay a Danegeld to the consultancy, or oftentimes they would have a relationship with a specific PBM, and they might tell their employer clients, carve out your pharmacy benefit and go with this PBM. It's totally going to be the best for you, when maybe it wasn't the best for them, but in fact was bringing in money for the consultants. And so this was a problem that Congress recognized, and they said, we have to take action. Now, they didn't want to go in and say, well, we're going to make a law that there can't be conflicts of interest, or that a broker can do this and cannot do that. Instead, what they said was, we can solve this problem with transparency, because what's important is that there is information, and that when an employer is getting these recommendations, they know that some of these recommendations may be shaped by some of the direct and indirect payments that are taking place behind the scenes that previously they were not told about. So the legislation that they started to put together to require transparency for broker and consultant compensation was part of a larger group of policies that were put together under the auspices of a bill called the Lower Healthcare Cost Act. And that was a bill that it was aimed at reining in a number of abuses that Congress saw in the healthcare system, and definitely not just focused on activity by brokers and consultants, but they were looking at, for instance, health plans not allowing employers to look at their own medical claims data. They were looking at what state all-payer claims databases were demanding from self-insured plans. They were looking at PBMs. They were looking at hospital contracts. They were looking at what were the emergency rooms and the so-called pair providers, the pathology, emergency, anesthesiology, and radiology. What were they doing, and how was that affecting patients? And what they did was they put all of this together into one big bill. That bill advanced through committee. It kind of languished for a long time, for over a year. And then at the end of 2020, a number of those policies were picked out of it and airdropped into this larger bill called the Consolidated Appropriations Act. So that's the background on CAA. That's where it came from. And it's the law of the land, right? And many of the provisions in CAA were implemented almost immediately, just a couple months after the bill passed. Others had a year or more of lag time, but this is a provision that is active right now. So what has this meant to mean? All of the policies that were included in CAA were meant to improve transparency. They were meant to improve the healthcare market so that employers and patients could make better decisions and be more informed in the decision making that they were engaged in. And also to ensure that employers, who do often have a fiduciary responsibility to the plan and to the patients therein, were aware of what those responsibilities were and would have clear guidance on what was expected of them. And part of that relates to information in, activities out, right? The more that an employer knows, the more information that they can act on. And that's the expectation that Congress and the administration have. So let's talk a little bit more about this specific provision relating to brokers and consultants. The Consolidated Appropriations Act included this new requirement, and it said that brokers needed to explain their flow of revenue that came from the different sorts of products and vendors that they were selling or recommending to their clients. And it was looking at a broad range of different services that a broker would be recommending or providing. And it was looking at a broad range of the different kinds of ways that a broker could be paid. Likewise, a consultant that was often helping employers to implement plan design and make changes to what their overall employee benefits program was going to look like would have to disclose the payments that they were getting in relation to a number of different services that they were involved in advising employers about. And you can see here, this is a pretty long list. It's not totally comprehensive. I don't think there will ever be a totally comprehensive list of this because it's going to be an evolving standard as brokers and consultants continue to evolve in their own right. But what we do know is that Congress and the administration have aimed to capture almost everything that was being recommended by one of these third parties to the employer plan sponsor. So moving on, we can talk a little bit about how things have changed. So first of all, TPAs have been involved in compliance assistance. They have been involved in all kinds of different services directly, but they've also been involved in recommending services and different vendors and providers of these various services to the employer. And so one of the things that's going to happen now is that employers are going to have a better understanding of what is it that may motivate these vendors that are being offered to me, or that the consultant or broker themselves, what is motivating them to make the choices on what they are offering to us? It's probably worth noting that the requirements for disclosure do have some exceptions in them, so that it's not a deluge of paperwork on the brokers and consultants or on the employer. So for instance, payments that are very low or that have to do with life insurance or disability insurance, those are not covered by this new requirement. But it is worth noting that in the case of a service that has been subcontracted, the entity that is contracted with is still liable for disclosing the interactions that are taking place there. It's also worth noting that this is meant to be additive and complementary to existing requirements. And there already were, of course, some expectations on what consultants and what TPAs were telling their employer clients about the conflicts of interest that they may have had at the given time prior to CAA's enactment. So what exactly are brokers and consultants going to be expected to disclose going forward? So first of all, they need to be clear about, are they going to be a fiduciary, or is this service going to be a fiduciary? And if so, they need to explain what is it that we'll be doing that will have a fiduciary responsibility attached to it. And as you know right now, oftentimes there are many questions about, particularly with an insurance carrier or with a PBM, what functions are they performing that may be fiduciary in nature versus what functions are not. There's also to be disclosed now going forward any indirect compensation that may be received by those brokers or consultants. So there are obvious fees that could be paid, like that fee I mentioned before, where the pay to play to get onto the sort of menu of options that would be offered to an employer. But there are also all kinds of other fees that are often paid, again, behind the scenes, that an employer would never know about, that could be included. Things like a finder's fee, where a group is moved from one insurer to another, or retention fees, where a broker is rewarded for getting an employer not to change carriers, sales bonuses, fees associated with overrides or changes to charges, etc. The universe of what this could include, again, is infinite, because there will be innovation in this space, there will be evolution in this space, and new kinds of interactions and new kinds of contract will be dreamed up. The idea is that it's all supposed to be captured, right? Those interactions that take place between the vendor and the broker or consultant, it's supposed to be captured and disclosed over here to the employer. So moving on a little bit, direct compensation. This one is more obvious, and it should be very clear what is direct compensation. But this is often fees that are just paid and contractually paid to a consultant. It'll be in the contract that the consultant or the broker has with the vendor that says, every time one of the plan beneficiaries uses this service, you get X, right? Which right now, again, it probably is not being disclosed to the employer, but it is critical in understanding why the broker or consultant may be trying to drive the employer and drive the enrollees towards these services. Of course, there's also a requirement to disclose any termination compensation. So if they have included in the contract, like, oh, if your client stops using this service, then there's going to be a payment that takes place, etc. Probably not the most impactful on employers, certainly not as impactful as direct and indirect compensation, but still useful to know so that you can have the information needed to make changes when and if you want to do that. So the regulations that have been rolled out for this do talk a little bit about the different kinds of disclosures and compensation. For instance, they talk about conditional compensation, right? For instance, the broker only gets paid if X happens, right? The consultant only gets paid if the client chooses to do Y. There are also a lot of discussion about indirect and non-pecuniary compensation, right? So this could be non-cash things such as meals, entertainment, gifts, rewards, trips. And as silly as it sounds, Congress actually was up in arms over one of the news stories that talked about how brokers could earn an all expenses paid trip to Hawaii if they got enough group health plans to choose a specific insurance company. And again, massive conflict of interest, but if it's disclosed, at least the client is able to make an informed decision, knowing that there is this motivation there that might be shaping the recommendations that they are getting. Let's talk about the disclosures. So when were they required? This is implemented now. It is active today. I can tell you that from talking to many of the group health plans that I work with, they have not received a full disclosure from their consulting houses or from the brokers that they work with. I think that right now, the brokers and consultants are still sort of coming to an understanding of what all needs to be included in a holistic disclosure on this issue. But it's worth noting that as contracts are being re-upped and renegotiated and RFIs are going out, et cetera, that sort of triggers a new opportunity for the brokers and consultants to provide this data to the plan sponsor. And of course, there are deadlines as well in the regulations that say that within 60 days, generally, there needs to be a disclosure, again, to prevent the employer from having to operate without the full gamut of information that they may need in order to make an informed decision. So it's important for the group health plan to remember that ultimately the buck stops with the group health plan, right? So the brokers and consultants, they will make recommendations. They will have some conflicts of interest, but ultimately it is up to the fiduciary, to the employer, to think about what are these conflicts of interest and to evaluate them and consider, well, you know what, there may be a bias here. This recommendation may not actually be the best for my plan beneficiaries. And I need to think through, what are ways to sort of account for what that motivation is for the recommendations that I'm getting and to ensure that the decisions that I'm making do reflect the fact that I now know about these conflicts of interest. Now, a group health plan is going to have some expectations from the Department of Labor. And it's important that when contracts are entered into, that the requirements be baked in. So one of the things that most of the employers that I work with are doing today is going through the kinds of contracts that they have with brokers and consultants and ensuring that they have made it very clear what their expectations are in terms of disclosure. And this is important because if they don't hold the consultant or the broker accountable for this new requirement, then the payments that are made to the broker or the consultant could be deemed a prohibited transaction. And we'll talk about that in a minute, how that, what are the consequences of a prohibited transaction. But I do want to say that it's not, don't freak out, right? Because it's not necessarily the employer's fault all the time. And the Department of Labor acknowledges that. And in fact, what they said was, if, for instance, the employer got the wrong information, right? The consultant gave them something, but it was vague and it didn't make clear what all the conflicts of interest are, that's not going to be the employer's fault. So long as the there is an effort to fix it, right? To look at it, to make a fair evaluation of it, and to say, this is not what we were expecting. This does not give us the information that we need. And in fact, the broker or consultant themselves will not be held accountable as long as they thought that they were doing what needed to be done. They thought that they were complying. That's what the good faith compliance standard means. It means that as long as a reasonable person who had a reasonable understanding of what the rules were thought that they were in compliance with the rules, even if they missed the mark, then what will happen is they'll get a month to go back and to change the disclosure to ensure that they're actually providing the information that needs to be provided. So there are certain cases in which the wrong or insufficient data going to the plan sponsor will again not be there will not be a penalty associated with that. So if the plan sponsor, for instance, didn't know that the broker consultant was just planning to, blow off the requirement and say, you know what, I'm just not going to do it. Or if they thought that they had the disclosure and they didn't have it, then that's okay. The plan sponsor is not going to get in trouble for that. But again, as soon as the plan sponsor realizes that something's wrong, then they need to take immediate steps to mitigate the situation, to get that information and to act on that information. A group health plan also needs to know that if they figure out that they didn't get the information that they needed to get, they need to write it down. They need to write a letter or some kind of formal request to the broker or the consultant saying, hey, we just wanted you to know we have received an insufficient filing, or we received nothing, and we need the information related to the broker and consultant transparency requirements. So please go ahead and send that over. And that way you're sort of triggering the timeline that's gonna be included in terms of penalties and who will be in trouble for whatever happens. So in the case that a covered entity, aka a broker or consultant, receives this request from the employer, they get the letter, they say, oh, I never sent my my fee disclosure to employer X. If they don't act on it with 90 days, the employer then needs to go and tell the Department of Labor. So again, the Department of Labor is not going to know that you sent a letter. They're not going to know that this particular broker or consultant failed to provide the information that you needed. And it is incumbent actually upon the plan sponsor, the employer, to tell DOL about that, or else the plan sponsor is actually being negligent here and potentially engaging in a prohibited transaction. So remember that if you fail to follow the requirements, if you fail to essentially crack the whip on your consultants and brokers, or if you fail to take this into account, the consequences are pretty steep, right? So the plan's fiduciaries will be held responsible for those bad choices, and they'll be on the hook not only to potentially pay back the payments that were made to this broker or consultant because they were a prohibited transaction. They were not made with the proper protections for the beneficiaries in mind and followed, but potentially a penalty on top of that. So you could end up being out the payment that you made to the broker plus an identical amount that you then have to pay back to the plan plus a 20% penalty. As you can imagine, the amount that we're paying to consultants and brokers, this would be a pretty significant penalty. And I think that most employers and plan sponsors are going to go out of their way to ensure that they are not assessed a penalty under that. They may not all get the information they need immediately. They may not all fix the contracts immediately, but you can bet your bottom dollar that they're going to go out of their way to ensure that when they don't get the information that they need, that they act on it in a timely manner, that everything is documented, that they have a system in place and ready to face the consequences of not receiving information that's needed. So in conclusion, what is expected? Well, plan sponsors need to have a process in place. So later you can explain that we did tell all of our brokers and consultants that we require them to comply with the broker transparency and fee transparency requirements. You need to have a system in place that will seek out those disclosures, right? I think that many brokers and consultants will do a good job of sending the information over in a timely manner, ensuring that the plan sponsor gets what they need when they need it. But for those that don't, remember, the burden is on the plan sponsor to seek out that information and to alert the authorities when and if they don't get it, or else you are not being a good fiduciary, and there are consequences to doing that. Furthermore, once you actually get the information, that's not enough, right? You can't just take the information and file it away. You need to have some kind of process in place to ensure that you're actually acting on that information. So what are the kinds of questions that you'll be asking about the disclosed relationships, about the flow of money, about the potential conflicts of interest? In some cases, you might find it might be glaringly obvious that the consultant has a huge incentive to steer your plan in a certain way, and that you definitely should be thinking about other options instead of the way that you're being steered. So what's the process in place in case that happens, in case the disclosures request that? And then, we think that it's also a good idea to make sure that all RFIs and contracts are updated so that you are ensuring that when a broker or consultant looks at the potential of working with you, that right off the bat, they realize, okay, if I work with this client, I'm going to have to make sure that I actually adhere to the requirements under the Consolidated Appropriations Act, or else they're not going to want to work with me. I'm not going to get that job. I'm not going to get that payment. So with that, I'm happy to take a couple questions if there are any. If I don't know, Jeffrey or someone else wants to moderate that. Just a reminder, this is not legal advice. It's policy advice. It's meant to inform you as you go to your brokers, to your consultants, to your legal counsel, and you figure out the next steps in ensuring compliance. But this is a new change. This is something that all employers are currently adapting to, and the brokers and consultants themselves are adapting as well. So we do expect some tumult and some turmoil in the coming months and throughout the year. But in the end, this is supposed to be a good thing for employers and for plan beneficiaries, because the more information you have, the better decisions you can make about how to construct a plan that really drives value for the people who work for you and for their families. So I do see one question that asks, is there a difference in rules for self versus fully funded plan sponsors? And I think that there is a difference in how you comply, but in both cases, the plan fiduciaries are supposed to get information that gives them insight into the recommendations that are being made. So I think Darren will probably go a little bit more into that, but I will say there are some commonalities and some differences as well. And of course, I was speaking mostly from the perspective of self-insured plans because we represent very large plans that are self-insured.
So James, I actually have a number of additional questions from individuals who unfortunately were unable to join us this morning. But why don't we defer in me asking those questions until Darren finishes his part of the presentation, because some of the questions that I have from those individuals not able to join us, Darren might be able to hit on or may hit on this morning. And thank you very much, James. Certainly incredibly informative and valuable information that you just presented.
Great. Well, I'm happy to hand control over to Darren now to proceed with his presentation.
Awesome. Okay, I think I've got control. Ooh, it keeps muting me when I try to do it. Do I need to? Okay, this works. All right, perfect. Great job, James. Usually I'm the one having to give the bulk of the compliance sort of related information, and it's a lot to get through, but very important to sort of detail thoroughly. There's a lot of confusion out there on different parts, different features of it. I think my only point of departure would be that you seem a little bit more optimistic about how the benefits consultants are going to be responding to this than I probably have, but that's okay. You know, that's just a point of difference. So I want to build on what you talked about today, James, by giving some insightful commentary on not just what the law requires you as an employer to do and know, but what you should expect of the benefits professional you entrust to help manage your company's health plan. So first, I'm just going to give a little context on who I am and how I come at this issue. I already mentioned a little bit of it earlier, but I think it's important to run through it really quickly again. Then we're going to talk about the expectations you should have of both your benefits professional and the compensation disclosure that they give to you. And lastly, I'm going to leave you with several questions that you can use, you can take away to initiate a much needed conversation with your broker or your consultant about how they're serving your business or not. So you have heard a lot about transparency today. So the least that I can do is be transparent myself. So 2 upfront disclosures, just like James said, I'm not a lawyer. I don't have a JD behind my name. This is not legal advice. I'm not qualified to weigh in technically on legal issues like that. And then the second one is that, as I mentioned earlier, I work for an employee benefits consulting firm. To be clear, that is not the capacity that I'm speaking as today. I'm speaking, we have an affinity for transparency in our own work. Otherwise I wouldn't be there. But that's not the capacity I'm speaking in today. I just want to be very clear about that. So 7 years ago, I started working at this nonprofit called the Institute for the Fiduciary Standard. And what we do is we highlight the importance of the fiduciary standard in investment advice and protecting the investor or the client from broker and advisor conflicts of interest. Often an investor, like someone who is planning for retirement, so it could be you, your mother, your sister, anything like that, just ordinary people, right? They likely have most of their investments in a retirement account. And a lot of people, if you ask them, will say, oh, I get free advice from my broker, the person that I work with. And the advice is nominally free, but you're not protected in that relationship because there's a lot of conflicts of interest behind the scenes. And I'm sure that you're starting to draw the parallels in your mind now between what James just talked about. So instead, the Institute sort of believes very fervently that investors would oftentimes be better off working in a fiduciary client advisor relationship who adheres to a fiduciary standard of care, not unlike the fiduciary standard of care that you have to exert over, towards your plan members. Very similar. So I have been focusing on analyzing these issues in the parallel world of financial advice. And then 4 years ago, I came over to employee benefits, excuse me. And I realized that the exact same issues that we were facing in the securities world were magnified, if anything, in the employee benefits industry. Employers have even less information about fees and value in their health plan than they do in their 401k and pension plans that they offer to their employees. So during the 4 years I've spent researching and working at fee-based and fee-only benefits consulting firms, I've been able to really draw comparisons between the two industries. The resemblance is striking, as I mentioned. As James talked about in his remarks, there's just so much that until very recently, employers had no way of knowing in their relationship with their benefits broker or consultant. It's distorted the health insurance and healthcare marketplace for decades. And some of the stories that have been documented by journalists like Marshall Allen in that link that he showed that he mentioned at the beginning of this presentation are simply grotesque. It really is shocking. And I think you saw that with one of the quotes that he pulled from it, which is right at the beginning of the article, because it's the headline grabber. It's supposed to draw you in. And all these experiences that I've had over the past almost 5 years now have culminated in me, realizing that there is a higher need for a higher standard of care, ethics, and client loyalty in the benefits consulting industry, which is how I come to you today in this way as the executive director of a committee that seeks to elevate the professional bar in this industry and to champion transparency and direct client fee compensation. And part of that, is talking to brokers and consultants about what they ought to be doing. But another very, very important part of it is exactly what we're doing today, which is talking about what you deserve and what you should expect in your relationship with them. So that's where I'm coming at this issue from. And with that as context, let's get into my relatively brief presentation because James covered a lot of the meat of it. So I want to point out the operative word in this title right here, demand. The CAA has provided you the opportunity to renegotiate the terms of your broker and consultant contract to ensure that it serves your interests properly. What you demand of that relationship is essential. What you will really change your health benefits for the better is what you expect from the benefits professional you do business with. So let's talk about some expectations. Compensation disclosure is the bar that now must be met, but it really should be understood as the minimum threshold for compliance. I mean, that's what the law says that they're required to do now. And so when they meet the bare minimum, that, just remember that that's what that is. And so the CAA presents a unique opportunity for you as the employer plan sponsor to scrutinize the broker and consultant business relationship for transparency in other ways too. Compensation is only one part of transparency. How do they serve your business? And we'll talk a little bit more about that later because I don't want to get too much into it now. Doing so, kind of going above and beyond on this and what we're about to talk about demonstrates prudence and process, which is really, really a vital point of fiduciary obligation, yours as a plan sponsor. And I think that, when I think of all of the fiduciary obligations, prudence and having a documented process really takes the cake in terms of the ethos, the most important part of what being a proper fiduciary means. It's what regulators look for and the courts look at when you are either sued or when you're audited. That's what they will look for, is like, you didn't have perfect information on the choices that you made. Of course not. We weren't omniscient. You couldn't possibly have known every contingency, but what did you choose knowing what you did know? And how did you go through that thought process? That's what's really important. So it's, I want to be careful not to overstate this, but it's just really hard to imagine the Department of Labor issuing a fine or a penalty to a company that's gone out of their way to do its due diligence on the CAA requirements and sort of take it to the next level and get really curious about how their broker, their consultant is operating and how they're serving their interests. And so I'll leave that there. Here's an idea that I've been thinking about a lot lately. You can think of brokers and consultants as kind of functioning on these two different axes. The first one is pretty obvious, it's their competency. But now with the CAA on the books, it's their transparency as well. So imagine a broker that's high on competency. They're super impressive. They're on their knowledge, their relationships, and understanding of the relevant issues. They blow you away every time you talk to them about stuff. Very impressive people. It doesn't mean they're transparent, clearly. In fact, if they're really smart, they might have been deploying their intelligence to skirt important details around you. And I assure you, that's probably been going on with most of you. That's not too strong to say. And on the other hand, you might find yourself working with someone who's really transparent. You might have started working with them because they're really eager to explain everything to you. They lay everything out. They have a great disclosure. Maybe they've already given you a good disclosure that's understandable. They're ethical professionals. But on the competency side, it's a little questionable. Not exactly clear that they're able to help you in all the ways that you need. And for the other areas of the CAA, it's really, really important to have a benefits professional who is very savvy and knows what they're doing, because some of those obligations that aren't in the broker consultant compensation bucket are pretty challenging. And there are smart people working on it right now who really haven't got it all figured out. So you want to make sure that you're working with someone who's really competent as well as transparent. So just to reiterate, the truth bubbles to the surface. Transparency by itself is no guarantee a broker consultant will be able to help you ensure reasonable expenses from all of your other plan vendors, which there's some ambiguity about whether or not other vendors like third-party administrators, PBMs, sort of fall under this broad covered service provider label that the CAA uses. I think it can be read either way. We'll sort of see how it ends up working in practice, and maybe the Department of Labor will issue more guidance on that. But again, it doesn't matter how the axe falls there. You want to make sure if you're running a good health plan and you really, really are trying to manage this stuff well, and you want your healthcare costs to decrease, you're going to be interested in trying to make sure that you're getting value in all the places in your health plan. So just a quick reminder there. The plan sponsors need somebody who are skilled and ethical. I think you guys all saw where this is going. You want someone that's in the gold box. You want someone who is functioning fairly well on both axes, and it's not too much to ask for. I talk to a lot of employers who don't really have I don't think they have a heightened awareness around this, or maybe they just don't really know what to look for. But looking for a really quality benefits consultant is one of the most important things you can do in a health plan. They help you interact with every single other part of the healthcare ecosystem. They don't have discretionary authority per se, but oftentimes the guidance that they give you sort of leads to the discretionary choice by you. So the relationship is extremely important. Do not undervalue how important it is. It is paramount. So I just want to leave you with a question really quickly. Who are you currently working with? The law and prudence as a fiduciary requires you to be clear-eyed and certain of the answer to this question. So if you don't feel confident in answering it, maybe that suggests something, it needs to be looked at again. So let's pivot to what you should expect in a disclosure. We're back in that expect word again. Let's talk about how an employer like yourself should think about what to expect in a disclosure. I always think that knowing how to think about something is far more important than knowing a few of the details about it. It's just really what the master variable is, sort of knowing how to think about it. I always feel a little uncomfortable when I don't know how to think about something. Knowing the precise details, you can go look that up in a PowerPoint slide. You'll have this after we're finished. So point blank, these disclosures should be brief and simple. I'm going to come out strong by saying that if it takes more than 2 or 3 pages for your broker or your consultant to explain how they're paid, that's a red flag. And here's what I mean by that. A research paper that I co-authored at my nonprofit, the DC nonprofit, in April 2020, explored disclosure in the financial services industry. One of the more egregious examples that I came across in my research was Ameriprise, which is a bank that, like all financial institutions, employs brokers who sell financial products like investments or insurance to investors. And in their 64-page disclosure filed with the SEC, which is the regulator that they have to oversees them. It's like the Department of Labor, but in the financial services industry. Kind of, not really the same, but. So in the 64-page disclosure, they took a full fourth of it to explain how we get paid. That was the name of the section, how we get paid. 16 pages in 10-point font with footnotes. Question, what does that say about the disclosure? Is that a disclosure that's intended for the recipient, the customer or the client, you perhaps, to understand the implications of how Ameriprise and its reps make their money? Or is it better understood as a one-way legal document written by an army of lawyers making $500 an hour for the sole and exclusive purpose of indemnifying them from as much legal liability as possible? I think the question kind of answers itself. And moving on to door number 2, we have Apple's terms and conditions, which I don't want to pick on Apple too much. There's plenty of these out there. Apple's just the first one that I first thought of. Apple could have had me sign my car over to them 7 years ago in the fine print. I never would have even known. We've all scrolled to the bottom of this and many others not reading a single word and hit OK or accept conditions. We do it each and every week for a variety of technology that we use. Again, are these disclosures useful or meaningful to you? So keep these 2 examples in mind when you're issued your broker compensation disclosure. Don't sign it if you can't comprehend it. Ask questions. All right, moving on to the second point. This is my pet peeve, one of my pet peeves. No more phrases like we may or may not receive supplemental compensation in the event that X or Y happens. That phrase is inherently non-committal, and it's intended to vacuum out any pretense of transparency that might have been there to begin with. A strategically ambiguous sentence like that is the opposite of transparent. And I'd like to also point out a flaw in the English language on this point, which is that the word may there can be read one of 2 ways. May, in that context, can either mean we may in fact receive additional compensation, or may could be taken to mean that we may, as in we are permitted to receive additional compensation. And it's very unclear how it should be read. So if you see a statement like this, you need to ask some pointed questions about what's actually being disclosed to you and how it might impact their ability to give you sound advice on your benefits. It's worth mentioning that the law currently allows brokers and consultants to give estimates, ranges, and formulas like James mentioned for compensation that they can't precisely calculate. And just a short aside, I fully expect most of the disclosures to use this. It's not, I wouldn't call it a loophole, but it's pretty close in the sense that it allows them to not really, it's sort of more that non-committal behavior where it's like, well, it even says in the field assistance bulletin that we don't have to actually spell it out. So, we're not going to disclose the actual dollars and cents. But that doesn't, none of this means that you can't ask for it as their business partner. And I think that's, that really highlights the absolute importance of employers in this ecosystem, is that you can ask for this type, you can ask for more, you can ask, this is expectations, right? You have the power to sort of drive this change from the bottom up rather than from the top down with the way that is currently done with regulation. Can't let that go to waste. So if they give you a range, ask them to transparently lay out a couple different scenarios of what the compensation might be in dollars and cents. They might say, well, it depends on enrollment. Yeah, okay, yeah, of course it does. Because a lot of brokers get compensated off PEPM or something like that per employee per month. So say, okay, well, what if we were to grow 10% in the next year? What would the compensation change to? It might not go up by 10% exactly because some of these things are much more complex than that. And I'm not trying to say that it's not, that the formulas are easy. Most brokers and consultants don't work on a flat fee. Flat fees are really easy to disclose. And that's why I think that they're better typically for employers, because it's easier for you to understand. I understand that there's some complexity in the calculations, but go through the exercise, say, I need to understand this. Understanding it is part and parcel to this whole process. And for me to feel comfortable signing off on this as a fiduciary. And so I need you to walk me through this. I need additional information about how much you're being paid and from where. And while you're at it, have them, and this isn't required by the law, just to be clear, have them, ask for them to accompany the current disclosure for the forward-looking year with what they actually received last year, a backward-looking statement of what they were paid last year in association with your account to compare. They'll have a little bit harder time wiggling out of that because they have the numbers. I assure you they have the numbers. They might not be able to attribute the exact proportion of the bonuses they received across their full book of business to your particular account. But again, if you're in a conversation with them and they're sort of talking about these specifics with you, that's useful information for understanding exactly what's going on. You're not in the dark anymore. You're part of the conversation. You are the one that's driving it. And they're having to grapple with you in real time with you about how much they're paid. And if you get a whole bunch of like really weird, vague answers that aren't clear, that right there tells you a lot about the relationship. So that you can't go wrong with sort of getting into the process with them. Okay. Let me make sure I go one more. Oh, and then the last thing to expect out of this disclosure is an expectation for yourself, which is to use the opportunity the CAA has presented you to have a frank conversation with your benefits professional, like I was just mentioning. So let's take a look at where you can start with that. And this is the last slide with content, just so you know. I won't take forever today. As I read these questions, I want you to notice that none of them can be answered with a simple yes or no. And this is intentional. I also want you to listen for how they are geared explicitly toward protecting you and your organization's interests. These are questions a fiduciary would ask when assessing the reasonableness of the broker and the consultant relationship. So this helps you in your process for determining if it's reasonable. Question number 1, how do you assist me in meeting my fiduciary obligation to my health plan members to pay only fair and reasonable expenses to you, to our insurance carrier, and to all of our third-party vendors? Very full question. Putting it to them and seeing how they respond will tell you a lot about the relationship. Number 2, are you and your firm financially rewarded or penalized when our company's health plans net expenses decrease? And why is that? This is really important to understanding one of the main conflicts of interest in this industry, which is that, in insurance worlds, not just in health insurance, insurance generally, the reps or brokers are compensated by a percentage of the premium. So like very easy to understand, very, very simple math. Like I probably don't even need to explain it. It's sort of insulting. Is like, if your health insurance premiums go up, their pay goes up. And that really is something that you want to think about. And if you can work with a consultant who, who doesn't have that arrangement, who actually makes more money when your healthcare costs go down because they did their job, that is something that's really worth explaining when you are scrutinizing this broker and consultant relationship for whether it's reasonable. So I'll leave it there. We can talk more about that in the Q&A if people are curious. Number 3, what specific experience does your firm, this is a broker firm, right? Does your firm have in reducing, not just managing healthcare costs while expanding or improving benefit offerings? So just quick note here, managing is the language of the status quo. That, it's again, non-committal. There's that word non-committal again. What does it mean to manage one's healthcare costs? It's like, well, they're not really committing to anything. It could go up, could go down. We're just helping you manage it. But no. Reducing, lowering, mitigating healthcare costs. That's what's important and meaningful to you. And if you can't pin them down on that, again, more information on the type of professional you're working with. I feel like, that would be another red flag for me if they're not willing to commit to that type of thing. In fact, I heard several years ago that in certain brokerages, the brokers that work for there weren't allowed to say that they reduced healthcare costs. They had to say managing because they didn't want to be responsible for when the premiums went up, and the premiums went up every year because that's the incentive for them. That's the incentive for the firm. That's how they make their money. Anyway. All right, number 4, how do you ensure that you and all of our third-party vendors fully and meaningfully disclose compensation to my company so that I may comply with the Consolidated Appropriations Act? So on the one hand, that's a question for them about this very topic. How are you going to help me, my fiduciary obligations, because you're going to disclose to me? Tell me a bit about that. Tell me what you do. And then also, how are you going to help me track down how much my health plan is paying everyone else that my health plan is working with? Very, very valuable information and crucial to coming into compliance in those other areas. Number 5, what does transparency in this business relationship look like to you? Very open-ended. Pose it to them. See what they say. There's probably 30 different answers that could come from this question, but the choice of words that comes out of their mouth first is important. And then the last one is, can you give me a past example where you or your firm recognized and mitigated or eliminated a client conflict of interest? And if they tell you we don't have conflicts of interest, that is just not true. everyone has conflicts of interest. Everyone is conflicted in this industry. The degree to which people are conflicted varies tremendously. But it's well recognized in the literature on conflicts of interest, period, the academic literature, that even if you're an advisor who has, or a lawyer or whatever, who has once you have your second client, you have a conflict of interest because you have to split up your time between the two of them. And so you have to mitigate the conflict of interest that you have between the two of them. So that's a sort of example that gets the point across. We're all conflicted. Don't buy that for a second. So I just want to open the discussion up to the Q&A. Summarize here. CAA has cracked wide open the conversation on broker and consultant compensation. Employers, especially self-funded ones, like James mentioned, but not just self-funded ones, also fully insured ones. We can talk about the difference in a minute. Have the responsibility, but also the opportunity to reevaluate how all of their service providers are bringing them value and at what cost. And this is consistent with, as James mentioned earlier, with the greater healthcare price transparency movement. Hospitals are having to be transparent about their prices. Insurance companies are having to disclose what they've actually paid, in fact, for some of the services historically. And this is just the next, the next one in line. So it's very consistent with the zeitgeist and what's going on right now. And so we can't let this opportunity go to waste, and we need to get these conversations started today. And so I'm really happy to be a part of that. And so I will sort of relinquish the reins here and look forward to talking.
Okay, thank you, Darren, once again. So the first question that I have from an individual, once again, who wasn't able to participate, was actually addressed in a number of comments from James, and it involves indirect compensation. Can you explain the term overrides that are paid by the BUCAs, the UHC, and Anthems to regional and national brokers and consultants, and how, and if those overrides are included in the disclosure for information that are included on 5500s? James or Darren?
James, you respond to that?
Yeah, probably not the best person to respond to that, although I know about the exchange of money that is taking place. But I don't know, Darren, if you want to give any information on that.
Yeah, I have a few things to say about that. So let's go ahead and get one thing straight. The Form 5500 is very well known to be lackluster in terms of the information that it provides. So that's the framing that's important to start off with. In my industry, if someone cites what's on the Form 5500, it's like we just know that's not serious. So that's what I would respond to broadly. Form 5500 captures insurance-related commission compensation. There is a section for bonuses, and so I would imagine that some, but not all, of bonuses are reported on it. And that's kind of like the trend in this industry, is that like certain things get classified in certain ways. In the PBM world, it's like in their contract they say, well, we'll pass 100% of the rebates to you. It's like, okay, well then immediately the buck gets passed to, well, what's called a rebate and what's not. And it's like the terminology becomes the battleground. And it's very much like that in the broker consultant world in terms of their compensation. When a broker gets per script compensation, that does not show up in the 5500 because it's not insurance related. So they can get a lot by you around the Form 5500. And the fact that the Form 5500s have been allowed to sort of persist as this bellwether, nominally as to what people should look at, it actually has been more unhelpful than helpful, I think. And to answer the second question, there really isn't, I was just thinking the other day, I was like, I know I'm going to get this question. What's the difference between override and bonus? I'm not 100% clear. I'd have to sort of look it up. I think that they're functionally the same. They're sort of interchangeable. People refer to overrides as bonuses. There might be some technical distinction between how something is sort of procured or received, but the overrides that insurance carriers pay to the brokerage houses are contingent upon retention, retaining clients with a particular carrier, a certain number of lives, that means members in this industry, right? It's the jargon. A certain number of lives retained with Blue Cross Blue Shield, for instance, or United Healthcare, as the case may be, or a certain amount of premium. So it's either retention or production, so new business that's being written. And so you can see that on some of the flyers that these insurance carriers issue, which literally say, like, if you write 800,000 in new business this year, you're going to be going to beautiful tropical Aruba. I mean, I shit you not, that's exactly what it says, and has a picture of like a woman on like a, you know, in a bikini on like a, it's just absurd. You know, it's like, it's something out of like the 80s or something. It's like, it's really strange. But I, you know, it's like, it's kind of hokey, right? I don't know, like maybe this industry will change a little bit. Anyway, I've said a lot more than I probably should have, but I think there's a few important points there, and maybe that heads off another question.
Well, Darren, I'm glad that I'm not the only one who finds the distinction between bonuses and overrides a little bit confusing. The best that I've figured out is that it has to do with sort of the dollar amounts that are being transferred from the client to the vendor, and the intermediary getting some cut of that dollar amount. And they can call it like a commission or an override, but it tends to be formulaic, right? And there is a mathematic formula that determines the amounts of the funds that are being transferred that are going to go to this third party. But others may have, you know, more specific definition as well.
And is it in the follow-up that they had to the question, is it, and Darren, you did touch upon it, but is it typical that those overrides, or Darren, I'll use your term, the bonuses are disclosed to the client? So that employer representative can actually fulfill their fiduciary role for the health plan.
I do not think that up to this point, bonuses for the most part have been disclosed. I think that was sort of the outrage a few years ago, and that was sort of revealed. I have been told that among the big brokerage houses, that up to that as much as 30% of their net revenue comes from bonuses. And in fact, it's the commissions and the direct fees, as the case may be, right? A lot of brokerages have both lines. They do a little bit of both depending on what the client wants. That those fund the operational costs of the business, and the bonuses that are paid at year's end are what actually goes to pay, again, like, you know, the bonuses of all the top representatives at the company. So that's what finances sort of all of the Christmas bonuses and the, you know, the lavish executive pay. And yeah, and I don't think that that's disclosed. And you know, and I think that this really opens conversation about what's going to appear on these disclosures. Are the brokers and the consultants really going to come clean on this type of thing? I don't know. I've heard through the grapevine that, you know, that Willis lost one of their largest clients once they disclosed, and because they said, well, this compensation is completely outrageous. And I think that a lot of employer clients will probably be shocked. I've sort of heard it likened to the business equivalent of finding out that your spouse has cheated on you. How much money that they've been raking in. And, you know, I thought it was a really funny way of putting it, but you know, it's not that far off. You've been working with someone for 15 years, and you're like, how much have you been making? That's crazy. I thought you're making a third of what you're making all these years. So yeah, the bonuses, I think, it will be interesting to see how they factor into this compensation disclosure. The point blank answer is they ought to be on there. They have to be. Legally, they have to be. All indirect and direct compensation law is very clear. So if they're not up there, and you need to ask to your broker consultant, you didn't disclose any bonuses to me, or does that mean that you're not receiving any, or did you leave something off? Please tell me, because most brokers and consultants participate in bonuses. There are only a few firms that I know of in the nation that culturally, affirmatively decline to accept bonuses. I've worked for a couple of them, and they're very, very serious about that. They put the checks in the drawer when they're mailed to them. And they don't cash them. But most consultants view that as part of an important source of their revenue. So anyway.
And Darren, it's probably worth mentioning that, you know, the reason why this is objectionable, and I think the reason why Congress was appalled by this, is because ultimately the money that these vendors are paying to the brokers and consultants is coming from the client, right? They're charging higher costs and fees, et cetera, to the employer in order to fund their ability to give these bonuses, bribes, however you want to describe it, to the middlemen to recommend them. And so when Congress passed this provision, the CAA, what they envisioned was exactly what Darren just said, wherein a large client sees this and says, well, I'm not doing business with you anymore if you're going to do business this way. And in the long term, there's supposed to lead to some kind of realignment, right? Wherein a lot of those kinds of compensation agreements go away. And so probably the employer has to pay the consultants and the brokers more, but the downstream products that they're buying could potentially cost less. And so you're still maybe are paying the same amount as you were paying before, but you're paying the actual recipients of the money, as opposed to this sort of secretive flow of funds that takes place in the current day. So that's the idea, is that it's supposed to be disruptive, and it's supposed to cause that kind of, people being surprised and saying, this isn't acceptable. This isn't what we want anymore. But will that work? Is a lot of it's going to depend upon what does compliance actually look like.
Yeah, I agree with that 100%. That's such a good point. Anyone who studied economics, and that's what my undergrad degree is in, is there's no free lunch. This money comes from you at the end of the day. One of the things that one of my previous firms that we would say is we would guarantee day one, engage a prospect, will save you at least $100,000 in your first year. Why could we say that? Because day one, we sent a letter to the insurance carrier if we took over his broker of record and said, don't take out the commission. We only work on a direct fee. And so the monthly revenue that was sort of flowing through the commission being paid by the employer and by the employee through their monthly insurance premiums every month got a little bit less, because it was, 4 or 5 or % of it wasn't going to the broker automatically every month. And so, I think talk about expectations. Yes, if you pay a higher direct fee, a flat fee up front, it could actually end up saving you a tremendous amount of money on the back end. And that's and that's what bending the cost curve in your health plan looks like, is day one, not paying those commissions and all these secretive bonuses. The insurance carriers pay them because they have to in order to sort of, that's their business strategy, but they recoup the money from you. Anyway, so James already mentioned it, so I won't harp on it too much, but it's such a good point. I'm really glad that you mentioned that, James.
So on the basis of the comments that you both just made, can you please comment on how the indirect compensation is impacting, either on a negative or positive basis, competition, especially with innovative solutions?
I'll let James respond to it first, because I've been talking a lot, if he wants to.
Yeah, I mean, I'll just say that I think that it's been news to particularly some of the big employers, the way that some of this works, right? And so they would go to, as Darren described it, these consulting houses that they have 15, 20-year relationships with, who have always helped to advise them and steer them on, this is the best new vendor, this is the best new product, et cetera. And suddenly they're finding that to get onto this consultant's recommended vendor list, it's just $1 million, right? It has nothing to do with whether or not you are offering a competitive, value-driven product. It's just a bribe. It's literally $1 million ticket, pay to play. And I think that it's shaking the core of some of these relationships that are very long-standing relationships of trust and reliance. Furthermore, many, especially large employers, will sort of cherry pick. They'll say, okay, well, you know what? I do want to go with Aetna for health insurance, but that does not mean that I want Caremark, right? So maybe I'm going to go to my consultant and say, you tell me, I want to pick a different insurance and pair it with a different PBM, et cetera. And the advice that they've been getting the whole time has been based upon bonuses and rewards, and one PBM paying them more than another PBM would pay to steer that business to them. It's really shaking to the very foundation what these relationships have been. But that doesn't mean that in the future there won't be strong, good relationships between these consultants and brokers and the clients. It just means that there's going to be some evolution to what the market looks like and what the business model looks like.
That's a good point. I do agree with that optimism. I do think it will be better. Yes. There's a couple things that I would add to that. I mean, yes, the word bribe really isn't too strong. I mean, the way that brokers and consultants have operated is basically just rent seeking. And that's really sad because I think that the value of the relationships and the networking and all the information is just tremendous. And so it's not like, you know, that's why I work for a benefits consulting firm. I think that what we do is really important in the marketplace. But when it goes from, you know, actively helping facilitate and broker the information asymmetry in all these complex transactions so that employers can run good health plans in this complicated system that we've got, which is more complicated than it needs to be, but leave it there. When that's a missed opportunity and the consultant is not doing that and is actually obstructing that process, that is, I mean, that's criminal. You know, it's really, really unfortunate. And that's kind of the situation that we're in. 2 quick points. Spoiler alert, most wellness programs in the world are, or excuse me, in this country are total bullshit. And the actual literature, independent literature reviews on most wellness programs, it's dismal. It's really, really sad. One of the reasons why there are so many wellness programs that persist long past the point where they should have failed as businesses a long time ago, because they're really, really not actually producing sustainable results. They cherry pick the data. You know, they're aided and abetted by the fact that they have an army of benefits consultants who they're paying money to keep them alive. You know, it's like watching a zombie continue to walk. And that is something that is sort of being fed into the veins of every employer in this country. And, you know, you can tell I'm really passionate. I get really animated about it because it's really important. It's really important because healthcare costs in this country are just going up and up and up every single year. And we don't have time for this nonsense. And I think it's when the broker and the consultant are being paid in all of these indirect ways from other sources that don't have to do with the client, that are the vendors of the client, it's parasitic. And it's one of the reasons why we can't figure, you know, the health care expenditures in this country have never decreased, not a single year. They've never gone down. And I think that the broker and the consultant is really at the core of it. So getting the compensation right and saying, I'm not comfortable with you receiving all this indirect compensation because it really calls into question whether or not you're actually working in my interest or not. I hired you to do a job for me. I'd like to pay you directly to do that work for me. And then if you succeed in providing value to my company, then we can talk in next year's renewal about a 20% increase to your pay. Like, why is that not part of the conversation? I mean, that's that simple, really. So I think like part of it is talking to brokers and consultants and getting them to understand that they really ought to stop accepting this money, because it's very sickening. And to answer your question, Jeff, that you passed along, it is at the heart of all the distortions in this economy, in this healthcare economy. Another part of it is telling employers, you ought to demand this today. No more being asleep at the wheel. No more assuming that this isn't happening in your health plan. It's just happening in other people's. It's probably happening in yours, and that's just the truth of it. So, hey, I will calm down now.
So in the Leapfrog symposium, and I don't recall which of the two of you touched upon a lawsuit that is reflective of the discussion this morning, but it was the lawsuit from a school district in Ocala, Florida, against Gallagher, I believe.
Yeah, Osceola. I'm not exactly sure how to pronounce it.
Yeah, Osceola. Thank you, Darren. Yeah. Thank you. Can you just touch upon that briefly? Because I think it's reflective of everything that you've discussed. Not everything, but many of the points that have been made this morning.
Yeah, do you know that case, James? I know it pretty well because I went and read the whole thing, but I'd be interested in your thoughts since you're an attorney.
Why don't you lay it out first, please?
Okay, so Osceola is a school system in Florida. Not exactly sure which part of Florida it is, which is kind of embarrassing because I live on the East Coast. And I should have looked at it, but they were suing Gallagher, which is an insurance broker, for receiving $2 million. I said $4 million at one point, but $2 million I think is the number that's sort of more legit. Anyway, they filed a lawsuit against him saying you received $2 million over 10 years in compensation that you didn't disclose to us, and we had in our contract at the beginning, and these are multi-year contracts, right? That you would only receive. There would be a cap on your compensation because we're a school system that provides health insurance to school teachers. And so they don't have $1 billion lying around to pay you, all this obscene money. So if you're going to be our broker of record, I think the number was like $145,000 a year. That's how much Gallagher gets. And you have to sign a document that says that's all you're going to receive. And Gallagher was instead was sort of siphoning on the back end, an amount that in fact, or sort of the school system is claiming netted $2 million over 10 years. And the only other thing that I would add, the case is still developing. I forget exactly where it is at the moment. I think that the district court said that this lawsuit could proceed. But one of the things in there that's really, really interesting that I don't ever see is that the school system is alleging that Gallagher provided fiduciary services to them. And that's one of the reasons why it's so egregious and that the disgorgement of the gains needs to happen. So it's not just that they failed as their duty as a broker and were secretive, it's also that they're saying, actually, in fact, based on how you held yourselves out to us when we initially engaged you, you count as a fiduciary to us, which is very different than how the broker and consultant role is traditionally understood. So how that lawsuit turns out will be really interesting because it could have some implications on how that relationship is viewed. So I'll let James weigh in.
Yeah, I mean, it's definitely an interesting one, especially because, brokers, consultants, vendors of all types they contort themselves into pretzels to avoid fiduciary responsibility, because once they have that fiduciary tag, then all these new requirements attached to them, many of which limit their ability to sort of pig out on fees and commissions, et cetera. And so if in fact a court does determine that an additional entity could be considered a fiduciary to the plan, and of course they'll be examining each of the different things that Gallagher was doing for that school district, right? Like, were they advising on how to structure the plan? Were they helping to pick the vendors? Were they doing side-by-sides and comparisons? Like, all of these different activities will sort of be judged one by one, and they'll try to determine, was that fiduciary in nature? Was this fiduciary in nature? But to the extent that grows from what is sort of, the most commonly held understandings today, that could have waves across, all benefits plans, right? Because every benefits plan suddenly is going to say, oh, this is now a fiduciary activity. Who's doing this for us? Oh, it's a law firm that's doing this for us. Oh, it's Mercer that's doing this for us. Oh, it's our insurance company that's doing this for us, et cetera. And in each of those cases, it'll change that relationship. So that's a big one. But I think that the example of a school district that is trying to cut costs, finding out that even though they had what they thought was a reasonable flat fee, and then on the back end, finding out that they were probably being overcharged $2 million by their vendors in order to send that money back to their own consultants who steered them to those vendors. I mean, it's just emblematic of what the entire problem is. This is similar to some of the challenges that employers continue to face with pharmacy benefit managers, where they're constantly trying to cut costs on prescription drugs. And what they inevitably find out is that the pharma companies are charging them more so that they can give that money to the PBM, so that the PBM will change the drug formulary to give favorable placement to their drug so that they can then sell more and charge more to the client downstream. It's the exact same sort of interaction that's taking place.
Yeah. Well, one last thing that I'll mention about this, which kind of gets to the heart of why the case would be important to you guys, is that what's notable is that the school system, as the sort of plan sponsor, decided to elect to go ahead and sue the broker on behalf of their employees. But what could have happened, right? An alternative universe would have been the school teachers would have been like so pissed off. How much money we pay? How health insurance premiums are going up again? Like, we don't have any money. I mean, I don't think Florida school teachers get paid all that well. Both my parents are teachers in North Carolina. They didn't see a pay raise in like 7 or 8 years. I really struggle to imagine the situation's all that different in Florida, just based on the way things are in these states down here in the South. If they had banded together and done a class action lawsuit together against their employer for not doing, saying, how are you letting the insurance company steal from us? These are commingled dollars. You're not doing your job as a fiduciary because you did not ensure that the plan expenses were reasonable. That is something that's happened before. And I have been made to believe by people who have followed this a lot more carefully than I have, that is the new wave of litigation that's sort of coming over the next few years with these laws like the CAA stuff on the books, is that if the employer says, this is important, this is just noise, whatever, they don't do anything about it. All it takes is for a trial lawyer to gather together a few disgruntled employees who are sick and tired of having a $5,500 deductible that they can't meet and paying, a lot of money for it each month. And they say, we deeply suspect that this plan is not actually being managed very well. And then you got a problem on your hands. And so I think that I don't know how to calculate the risk. I'm not a lawyer, but I do think that there is a risk there. And lawyers have told me that they think that the risk is not insignificant. So, that's just something to think about, about how this kind of stuff works. It wouldn't be surprising if it went down that way, because that's exactly what happened in the 401k space when that industry got reformed in 2012. And that's how all the standards changed around what type of investment products were suitable within 401k retirement plans, was that it wasn't the legislation, it was the class action lawsuits of people saying, I'm missing $15,000 out of my retirement account over the last couple of years because of the vendor that you chose. They were charging egregious fees. The fees were too high. I lost out on my retirement, and I want my money back, and so does my other 200 fellow coworkers. That's how that kind of thing developed. So that's what's relevant. That's also something to think about with a case like that.
And Darren, to your point, it's worth keeping in mind. Remember, it wasn't the vendors that had to pay that money back, right? Like the vendors, they sold a product and the plan bought the product, right? It was the plan that was held accountable for that, right? The vendor, they just sold a badly priced, 401k fund that didn't perform well and had high fees, right? And interestingly enough, there was another recent case in which a number of plan beneficiaries sued Anthem and Express Scripts over a business deal that they had, wherein the patients were kind of locked into higher drug costs than they needed to be, as part of Anthem sort of spinning off one part of their business in order to launch their own PBM, et cetera. The patients lost that case, right? And the reason that they lost it is because Anthem and Express Scripts did not owe a fiduciary duty to those patients. Right? They were just doing business. And that's what the judge said, was that this was a business transaction. They chose to set these prices, et cetera. If they were contracted through an employer and the employer had been the target of that lawsuit, it could potentially have come out differently.
Interesting.
Dave, any questions for James or Darren?
Well, I do have two actually, and one's going to be a bit of a follow-up around things like the override question, and it comes back to the whole disclosure issue. When you look at something that's, a bonus arrangement or an override arrangement that has a trigger that's based on the total book of business that say a brokerage brings to a insurer, how much disclosure can the employer get? Can they ask the broker, and should they be able to receive the information from the broker about what the total book of business is that the broker brings to that insurer, not just what their employer's share of that is?
Yeah, that's such a good question. And it's one that I've personally been wrestling with a lot. How do you attribute the proportion of the bonus that may or may not have been in association with one account? So I think that the actual answer is that most brokerages probably will use that as a way to not disclose it. I think that's what's going to happen. Okay, so I that's what to expect, I think. But and I also think this highlights the fact that it's really unfortunate in this particular instance that the liability is on the plan sponsor, because the liability we're on, if the department could regulate the broker and the consultant, they could sort of say, we know that's hard, you guys got to figure it out. They can't really say that though, because it's the plan sponsor's responsibility. So I think the plan sponsor has to ask the question thoughtfully and say, what will you do to help me understand what percentage my book, my account, my group health plan on your book of business, what kind of, how should I be made to understand how the bonus applies to my account? And then make the broker and the consultant figure it out. I mean, I have a couple ideas about it. Like, just do the math, like figure out like, okay, well, if you had $1 million in bonuses from Blue Shield, like count up all your Blue Shield accounts and I don't know, divide it by premium or lives or something like that. Like do something to try to slice it up. Like, I don't think it's rocket science, but I also think that it's just complicated enough that people will try to sort of, put a whole lot of stuff, different types of things through. So that's my answer to that.
I would also just add that, like, Pre-CAA, a broker could potentially say to you like, oh, this isn't specific to your company, so you have no right to this information. Post-CAA, there's no question that the client does have a right to that information in some form. I think probably what might be in contention is, do you have a right to know the dollar amount that a broker gets paid due to another account, right? And that the answer to that may well be no, but then you would still have a right, for instance, to a formula that would explain how they get paid, and then to understand how your own payments and your own business factors into that formula. So you at least have a right to something. And I don't think that there's any, I don't think anyone could push back on that, but how much of it do you have a right to, I think may be in the air.
Yeah, I agree with that. CAA definitely changes some things by actually putting it on the books and saying, like, now you have an obligation to know, you have responsibility to know, and therefore you have a right to know these things. That's really important. You would have never been able to get that information ever before CAA. It would have never given it to you, but you had to pry it from their cold, dead fingertips. Anyway, Dave, what was your other question?
No, that's really helpful. I think the other question is, a lot of brokerage houses and consultants have created product solutions that they sell to employers. And, for example, a pharmacy coalition or something like that, where they are effectively taking a piece of the overall product cost as a management fee, or as some kind of fee that is structured, not necessarily directly to the employer, but to the overall product base. Does that need to be disclosed? And is it, from a employer fiduciary perspective, does the employer need to have some element of return on investment calculation or something that says it was legitimate to use the product that this consultant or broker brought to me in terms of actually delivering benefits to my people?
It's a good question. I haven't considered that exact scenario, so I have to think about it. But I think the employer really, they deserve and are obligated to know the information about how much the broker or the consultant is making on these recommendations, even if it's not direct. So if it's indirect compensation, yeah, it still has to be disclosed, because if they're making a 10% commission or something outrageous on this product selection, that's part of the fiduciary process for the plan sponsor to say, gee, what does that say about whether this product is the best on the market? If they're receiving a pretty substantial amount of money off this, then I need to sort of adjust my expectations about whether this is a product that's right for me, or if it's just a product that's being nakedly sold to me because it's something that makes the broker or the consultant a lot of money. They could be being compensated well and it'd be a great solution. That's a potential outcome. I'm not trying to foreclose on that and say like, oh, if the broker and consultant's making a good living, good amount of money, and then nothing, it's not appropriate. Like, that's not what I'm saying. It's a very important variable to consider. So I think that's where I'll leave it. That's a good question though. I'll need to think about those types of situations more.
And I would just add that I think the intent of the law was that the employer would have access to that information. I think that the real world implications though might be that because it's not a relationship with an external entity, it would be hard to segregate which of that money is going to operations and which of it is going to profits, right? That's just going to be difficult to do. I do think though that the majority of these kinds of products that they're offering, I think, are in conjunction with an outside vendor, right? They've got some specific company that they're working with, and that may be the way to get at it, is because they're paying that outside vendor for that service, even if it's branded with the consulting house.
Mm-hmm.
Well, we are at Dave.
No, go ahead.
Okay, we're at time. Any closing comments? I'll start with you, James.
No, I would just, urge folks, get this information and then act on it, right? Don't just file it away. This is important. And ultimately we could be held accountable for how we treat it.
Yep.
Thank you. And Darren?
Definitely agree with that. I also realized we didn't answer the fully insured question. I don't know if the person's still here. Fully insured is just a quick answer. It's a little easier because it's sort of a flat commission on the total amount of the premium. So the disclosure should be relatively simple. There might be a few other extra things if you have some bells and whistles in the plan. It will be simpler in nature, but that doesn't mean that it's any less substantial in relationship to the amount of the premium. So, I think it's hard to track down the sources of compensation in self-funded groups, but yeah, that's kind of how I would talk about that. But anyway, thank you so much. It was really a real pleasure to be here. Really glad to talk about these ideas that clearly matter a lot to me. And I feel like I learned a thing or two from James. So this has been very profitable for everyone, I think.
Well, once again, I would like to thank both of you for taking time in preparation for the symposium this morning and also spending time with us. The information that has been provided certainly is actionable for the employer representative, especially in their role as a fiduciary for the health plan. And I would also like to thank those who joined us this morning. And if you should have any follow-up questions, feel free to email those to me. And as I stated at the start of the session this morning, we will be sharing the recording and look forward to the continued dialogue on this incredibly important issue. So with that, thank you very much, Darren, and thank you very much, James. Really do appreciate it.
Good to see you. Thank you.
Thank you.
Thanks.